Hi, do you have luck in your finances? Yes, I'm talking about liquidity, use, and control of your money. I'm Julie Kranitz and I'm a certified financial planner. I have a Bachelor of Commerce from McGill and I'm the president of Wealth Maximization Group. But who cares about that? Let's talk about what's really important. Have you heard that cash is king or queen, depending on how you look at it? Yes, financial liquidity gives you financial flexibility, and who does not want flexibility in their life? Because if you see a great deal, I don't care whether you're doing your groceries and you want to stock up on cans of tuna, or whether you see a great new car that's piqued your interest, or even a great piece of real estate, you need to have access to capital. So let's talk about that. There's kind of a couple of things we want to look at. First of all, you should have some savings. You have to have, depending on who you're speaking to, 3 months to a year of money. And you could also have access to a line of credit. Just keep in mind that a line of credit is not quite as secure as a loan, because they could increase the rates, change the terms, or they could call the line of credit depending on what's going on. Now, if you keep making your payments, probably never going to happen, but just something to keep in mind in the back of your head. Now, most people, one of their major investments that they own is they own a home, which is, as you know, one of my favorite investments. Tax-free, all good. But what is the problem with owning a home? As you put money into your home, people feel more secure. They have paid down their mortgage. But here's the question, is that money really liquid? If I needed that money tomorrow, could I access it? And the answer, if you really think about it, is not necessarily. I have to qualify for the loan. Once I've paid off the mortgage, I have to qualify to borrow that back, which means I have to be earning income. I have to be able to make the payments back. Okay, let's look at this for a minute. Do you think putting all your money in your house is the safest thing to do? When I started my CFP, we were taught every time we had some extra money to pay down non-deductible debt. Now I'm not so sure putting it in my house is the safest thing. What do you think? So let's say we both had a house. So we both own exactly the same house in the exact same location. We're right beside each other. Each house is worth $1 million. We have both worked hard and have saved in two different ways. We've both saved $800,000. You have put $800,000 onto your mortgage, so you only owe $200,000. Yay, you! That's awesome. I have saved $800,000, but I have $200,000 that I have down on my house, and I have $600,000 sitting somewhere else. Here's the question. If we were both very unfortunate and got sick and couldn't work, and we missed 3 payments on our house, who would be in a better position? Well, if you think about it, I have $600,000 sitting somewhere else, so I could definitely use that to make the payments. But you, if you put every cent in your house, wouldn't have any money to make those payments, and the bank would foreclose on you. That would be unfortunate. This is what happened to a lot of the people in the US that had diligently paid down their houses. To my surprise, the people who lost their houses first were the ones that had more equity. Because let's think about it. Let's assume the banker is sitting here and he sees, forget about my savings, he just sees that I have $200,000 of equity and I miss payments on my house. You have $800,000 of equity and miss payments on your house. Which house do you think the banker is going to go after first? He's going to go after the one with $800,000, right? Because if it sits on the market for a while and he can't sell it, he will still make a profit or make more money by selling the house at $1 million and then recovering the loan, whatever the difference is, versus my house where there's only $200,000. For me, he'll probably pat me on the shoulder and say, Julie, do the best you can, because every extra dollar I put on the house, then the bank is in a better position. So let's look at this a little differently. One of my mentors, actually, this happened. He was in New Orleans when all the flooding started, and he did exactly that. He had the minimum money in his house, the $200,000, where his neighbors had just about paid off their houses. So guess what happened? When all the flooding happened, there was a lot of time that it took to get evaluations, but he was able, because he had money set up somewhere else, his $600,000, he picked that up and went and bought a house in Atlanta, and didn't even have to worry about waiting for all of that to get settled. And the irony is, when the banker was fighting to get with the insurance company to get money to pay off the house, whose house do you think he was fighting more for? The one who had only $200,000 still owing on the mortgage, or the one that had $800,000 owing? My friend who only had $200,000 of equity in his house and owed $800,000, they were fighting super hard to get that money back so that they would be whole. Anyway, so here's the question. Is it the safest thing to put all the money in your house? And is the money in your house really that liquid? I would say no. You gotta have money somewhere else. So leave a comment below. Tell me your thoughts on having cash reserves. Remember, there's certain investments, they're not good or bad, that they have certain different criteria. So your GIC may be safe, but it's not liquid because it only is liquid when it matures, unless you die, of course. And if you're dying, you're not accessing it. So it's not that liquid. What about your bank accounts? Your bank accounts are very liquid, don't pay high returns, but very liquid. What about your RSP? Well, your RSP, depending on what it's invested in, it could be liquid, but remember, you got to pay the tax. Another one of the greatest ways to get access to cash is permanent life insurance, the cash value. You can borrow that money anytime. A lot of you have already heard Walt Disney. That's how he started Disney, was by using the cash value in his permanent life insurance, because when he went to the bankers, they weren't willing to lend him money for swampland in Florida, basically. So here's the thing. Remember, we're talking about having luck in your finances. We want you to have liquidity, use, and control. We want you to have access to cash throughout your life and your retirement so that you can have money available for a rainy day or for opportunities. Both are so important. So here's the thing. If you like this video, please give it a thumbs up. Make sure you subscribe to our channel so you can get other videos, and please hit the bell and you will be told when we bring out another future video. And be kind, share it with a friend. Remember, Julie Kranitz, Wealth Maximization Group, maximizing your wealth to maximize your life. Thank you so much. Have a great day.